So you know how life is super busy and there's so many financial products and there's so many financial people, it's hard to make financial decisions? I'm Adam Gane, owner and financial coach of Gane Financial. We help families with businesses as a one point of contact to integrate, coordinate, and organize your whole financial economy so you can save time and energy and live the life you want to live. All right, guys. So today we're going to be talking about the main model we use. This is called the LEAP model, and it helps us integrate, coordinate, and organize your whole financial economy. So you can kind of think of this as a way to look at your whole financial economy from a 10,000-foot view. And the model, it's split up into three main components. So we've got protection. There's 9 different elements. We've got the savings component, and we've got the growth component. So I'll let you take a look at that. Now this model, it took 10 years to design, and it's been consistent for 45 years now. And the economist that created it, he's in the States, so it is mainly based in the States, and there's probably like maybe 30 advisors in Canada that use this model. Again, we just like to use this because it helps us see everything and it helps us make much clearer and better financial decisions. So to go into a bit deeper into each component, we've got the protection component. There's 9 different elements in each component. Boxes, elements, whatever you want to call it. Now each level, each row has different types of assets or protection inside of it. So the first level, these are one-dimensional products. They just cover your assets. The second level are two-dimensional products. They cover your assets and income. And then the third level is three-dimensional assets, income, and life. So pretty much as we go from P1 to P9, your decisions get more and more important. And that's more or less the protection component. I should also mention that each element is numbered. So you can see the P1, S1 to S9, and then G1 to G9. So pretty simple and similar for each savings component and the growth component. Each different level is a bit different. So every asset in Canada can go somewhere in one of these 27 elements. Now the overall model, so I've created like a sample model here. The overall model looks a little bit different. You've got some of your information on the left. You've got your liabilities here and some additional information. But more or less, you can see all of your assets on this one piece of paper. So think of this as the game board to everything that we do in the financial game. Now you can't play any game like Monopoly, you can't play it without rules. So of course there's rules associated with the game. And that's what I want to look at next. And there's actually 9 main rules. I'll let you guys take a look at that. So we call these the rules for prosperity. And the way we look at this is like the ideal model. You know, we're always trying to get closer and closer to that ideal. And think of it like the horizon. We're running towards the horizon. You can't really ever get there. So you can make your model and your money more and more efficient. But by following these rules, we're going to set up a defense first plan. So rule number 1, maximum protection at minimum cost. You know, we're going to take a look in each of these different elements in the protection component, go over in detail how these work, make sure you guys understand them to see if that's something that you want. And if you want it, then we can implement it, and if it makes sense. Now, of course, if you look at what this says, maximum protection, minimum cost, that's the opposite of what the insurance companies want, right? They want minimum protection at maximum cost. So, you know, there is ways we can set up your financial economy so that potentially you can get the coverage with no out-of-pocket cost, just understanding how these products work.
I like that.
So rule 2 is we want to save at least 15% of your gross income. And we want to make sure that this is an automated process and that it's segregated. So we want to use a separate bank. And we use this S1, it says WCA. That stands for Wealth Coordination Account. And this is probably the most important element on the whole model, this S1, because it is the quarterback to everything. Money goes in, and then it gets distributed to everywhere else in the model. And if you start making passive income or rental income, then we can put it right back into the WCA. At the end of the year, you can know exactly how much you saved and where it all went. So it gives you a lot of organizational there. Rule number 3 is we want to have 6 months worth of income liquid at all times. Now, we typically like to store this money not just sitting in a bank account or under a mattress because it's not doing anything. We want to have that money moving for us and doing something for us. But we don't want to lose liquidity. We want access to it because we're going to be talking about in the future, there's 5 main purposes of cash. Ideally, we want this some in your WCA, really easy to access, quick. Potentially home equity line of credit if you have a house. We want access to that equity, so potentially if there's opportunities or something pops up. And we want in cash value life insurance and a whole life policy because we can access that and it can grow tax-free. Rule number 4 is we want to avoid compounding in a taxable environment. So tax is the number one eroding factor, and it's very hard to grow money long-term in a tax environment. It's almost nearly impossible. So, of course, we want to utilize all of our tax-efficient products first, and then we will look at how do we eliminate growing in that taxable environment in other ways. And, of course, eliminate bad debt. Bad debt, there's actually 3 types of debt. There's bad debt, there's good debt, and there's better debt. Right? So if we look at this model here, and you've got a mortgage, which is good debt. You've got an asset attached to it, same as your car loan. It would be close between bad debt and good debt. I would say a car loan, but if you maybe if you had a home equity line of credit and you borrowed that out to invest or do something else with, it's backed by something and it's tax deductible. So that's better debt.
Gotcha.
The worst debt, obviously, credit card debt, the high interest where it's pretty much just spent on lifestyle. So that covers the first 4 rules cover the defensive side of things. And in the model, as soon as you go below this line, you go into the offense and you're leaving safety behind. So everything now we're taking risk with money. And we want to make sure that you have your basics covered before you get into that offense. And really what I'm trying to do for clients is build this huge financial castle. The first thing we have to do is dig the moat. If you have a good moat, then you only have to build one castle throughout your life, and you can have a strong foundation, and you don't have to worry about getting attacked or eroded throughout time. So offense, this we don't need to go into this order at all. It's not in order, but ideally, if you have an employer matching program, we definitely want to be contributing to that so that they're matching our contribution, but we don't want to put more above the match. Because as soon as you put money above there, it's going to be locked in, and I think of it as almost like in prison, right? We can't access, and it's no benefit to us. There's no motion of money of that money in there, and it's just locked in until you decide to retire or become financially free. We want to make sure that we're lending money. So in the U.S., they have municipal bonds. We don't have municipal bonds in Canada. When we talk about lending money, we also talk about private debt. So you can do second mortgages, first and second mortgages. Rule 7 is owning soft assets. So this is typically equities or stocks, but we also put in private equity in here. So investing in Canadian businesses. And then number 8 is owning actual physical hard assets. And this is where potentially your cars, if you own gold, physical gold, real estate or businesses. And if I go back to how the model is designed, and we talk about each level has different dimensions. Just because these are 3-dimensional products, they give you income growth and tax advantages, doesn't mean we should have all of our assets here. Really what we're trying to do is to create a model with 1/3 in the first level, 1/3 in the second level, and 1/3 in the last level. And if we can do that, then we can pretty much be making money in any condition, really any type of economy or changes in rates and all of these things. So that just sets us a lot of diversification. Now, of course, we want to be utilizing as much as we can from the TFSA, or if an RSP is applicable, or other tax advantaged products. Now that you guys understand the model and you can see how the rules work, typically what we like to do is we like to look at your model and we like to compare it. And we like to say, okay, if this is our ideal model, the rules, how do you compare and where can we improve and where are our areas of concern? And so I like to use some colors on here. So in this instance, in this sample model, what I would be looking at is we use 3 different colors. So we've got green, yellow, and red. Red is an area of concern or something that we need to look at in more detail. Green is pretty good. There's not a lot to talk about, well protected, or you're satisfying that rule. And then yellow's in between. So in this model, we've got vehicle insurance is looking pretty good, property insurance. In Canada, we have good protection. So those are all green. Now, there's always conversations around deductibles and liabilities. And in this case, they have what's called an umbrella policy. And that $5 million umbrella, it adds to their liability in each of these. I should also mention that the numbers and the arrows, these are what you're paying for that type of coverage. So blue is going into the model. And if you're making money from any of these elements, it would be coming out of the model as green. Now, disability insurance, the mom right now has some group benefits. So, we can always do a little bit better on the group side of things. There's a little bit of protection that we can maximize, whereas the dad has no disability protection. Now, we know our income is a large asset. So it is probably our largest asset. So if he ever gets injured or sick, then that could be devastating to the family.
And to change that, we would get another policy.
Potentially. Yeah, we would look at the different options available and see if it makes sense. And that money would come from the WCA, from your savings. The next element, so this is P5, it says medical insurance. Now, in the States, they have to get their own medical insurance. We put critical illness here in Canada. So that's going to be red. They don't have any critical illness. Government plans, this number shows the child care benefit that they're receiving. That's something we always will have yellow. We always have to keep an eye on what's going on, and we want to make sure that we're maximizing whatever we can get from the government.
Mm-hmm.
So the wills, this date represents when did you start a will, and then when have you last reviewed it. Mm-hmm. I typically will mark this green if you reviewed it in the last 5 years. Well, you have a will and you've reviewed it. So they haven't reviewed it in the last 5 years, so that's going to be yellow. And life insurance, they both got some term insurance, $500,000. That we need to go into more detail to see if they potentially, if that's enough coverage for them, if that's what they really want for each other, if they weren't here. If we're looking at rule, so that's all of rule 1. And if we're looking at rule 2 in creating a savings process, if someone doesn't have a process, then I'm going to be marking that red. If liquidity, so if you don't have up to 6 months liquidity, so in their case, they're making $250,000, so we'd want about 125 liquid at all times. And if their home equity line of credit, it doesn't have that much, then I'm going to mark this element red. Other than that, those are the main things. We'll be talking more about, investing, how to make things more efficient. This also shows the teacher's pension, what you're contributing, what the employer is contributing, and then real estate. So the rest of that looks good. And that kind of lets us know where to start.
Mine is, again, how do you get to the next level so that you're not in the red? Mm-hmm. And then also, is it going to impact our lifestyle to do this?
Right. Great question. So the answer is it depends. The answer is always it depends. You can move to the next level or move your colors to a yellow or a green just by understanding what's going on in that element, mm-hmm. and then making a decision if that's important to you or not. And typically, we're going to talk about a savings process and what that looks like, and if we can create that at no out-of-pocket cost to you. Mm-hmm. So is there places in your life we can look at that we can make more efficient, we can bring money back to the table that you can save. And if you don't feel comfortable saving up to a certain amount, well, then we work towards it over time. But my job really is just to whatever you decide to put into that WCA as a savings amount, my job is to help maximize it. And you get to decide where it's going to go, what's important. So you might decide that it is important to put a few more dollars towards this element, or maybe it's this element over here, or maybe you would rather put it more into like a TFSA or into the growth. So we'll look at that. Once you understand all of the elements, you can start making macro decisions.
The other question I have is, as our life changes, whether it's we now have more kids, whether we now have to care for family members, whatever, is this going to be able to work with our life changes?
Yeah, so that's the great thing about this model is what we're ideally trying to do is based on these rules and what you decide to put into the model is we want to maximize that 1 year at a time. And what we're trying to do is pile on 1 year perfect models on top of each other for as long as we can. So you'll be in the best possible position you could be in at any time in life.
Okay.
And maybe when you get to that retirement, we're going to be have your money positioned so that you can spend and enjoy the most.
What about like our dreams? Like, where would you put in here? Like, I want to have a farmhouse one day that is going to be, decorated the way I always wanted it decorated. Where does that fit in here?
So the dreams is where our GPS is going, right? So if we have a destination in mind, then we can move this model to where it's going. No, that's like kind of like the castle, right? Now that's great that you want that, but I would say that if we can build that moat first, if we can get that protection, you positioned properly, then we are going to guarantee you're going to get those dreams. Because we're first positioning, and as life happens, things are going to happen. And if you're ready for those things, then you're going to have less losses throughout time. Or an unhappy journey never leads to a happy ending.
Right.
So we want to have fun along the way and in the future.
And I think that's one of my biggest concerns whenever I think about saving and money and all that is, do I have enough for all of those unexpected things that are going to happen in life, but still end up where I want to go?
Exactly.
Right?
Yeah.
And still enjoy what I'm doing now. Like not being able to enjoy life now. So I have retirement, but enjoy now and also enjoy my retirement, that I don't have to retire at 75 like my parents did.
Or
That's
I don't
right.
have to wait till we're retired to travel.
Yeah.
Too.
Yeah, and I would say the biggest thing to that is when you can segregate money and use a savings process, then you know that you're doing what you need to do for your future. And everything left, you can have fun with. And you can feel good about spending. And so that segregation really helps our minds differentiate between that. And it helps you understand, every time you're pulling money out of your WCA, then you're borrowing from your future. And that means we can be more efficient with money. Okay, I think that's everything. Thanks a lot for watching that video. Check out some of our other videos. Subscribe to our channel. Feel free to reach out anytime. We're looking to work with great people long term.